Tesla has experienced phenomenal growth over the past decade, but it appears that this trend has ended. Compared to the same period last year, Tesla sales decreased significantly in the first quarter of this year, and for the first time since 2020, the company is experiencing a decline in revenue. Simultaneously, production exhibited minimal change. As a result, thousands of Tesla electric vehicles are currently accumulating throughout the United States. This is just one of the company's 7 major challenges at present. Number 6. Thousands of Tesla electric vehicles are accumulating. Commence by examining one of the most recent signs that support Tesla's predicament. More specifically, numerous sources have recently reported that Tesla vehicles are accumulating not only in dealer lots but also in adjacent areas. Production is in such excess of demand that the organization is facing challenges in locating storage space for the numerous models that are presently accumulating dust while awaiting sale. It began with reports that 400 Tesla models were discovered abandoned in the parking lot of the St. Louis shopping mall, but it quickly became clear that this was far from an isolated incident. Similar circumstances are being observed in the parking lots of the Quaker Bridge Mall in New Jersey and the former Chesterfield Mall. As stated by commentators, locations such as the Buena Park Mall in California and Roosevelt Field Mall in Westbury are also afflicted with the same predicament. There is no doubt that the issue at hand is significantly more extensive. Due to the company experiencing its first sales decline in years, the first quarter of 2021 concluded with an 8.5% decrease in comparison to the corresponding period of the previous year. Professionals estimated that approximately 11% of the inventory remained unsold throughout the initial 3 months of the year. In comparison, the company's surplus was a mere 2% in the previous year. As it turns out, the Austin-based company sold approximately 387,000 vehicles during the initial quarter of this year, compared to a total production of over 433,000 units during the same time frame. In other words, the organization possessed an enormous surplus of 46,500 unsold vehicles. Due to the absence of a dealer network, Tesla does not disclose precise figures regarding market day supply. However, industry experts approximate that the existing inventory would require approximately 90 days to sell. In contrast, Toyota currently has a market supply of merely 27 days, which provides significant insight into the future that Tesla might anticipate. Number 5. Steep discounts and negligible profit margins. The growth of the EV market slowed gradually over several months. It did not occur immediately. Therefore, Tesla began offering steep discounts on its models as early as the third quarter of the previous year. To provide a more accurate depiction of the present circumstances, consider that the Model 3 is now available at a base price of $39,000. At the beginning of 2023, the price ranged approximately $47,000. A comparison of the prices of the most popular models from the previous year to the present day reveals much. Furthermore, even the mean cost of Tesla automobiles has decreased substantially. The prices have decreased by approximately 21% in the past year or so, from around $63,000 to $50,000. A few weeks ago, the most recent price reduction occurred, and all models were reduced by an additional $2,000. Presently, the Model Y can be purchased for a price below $45,000. In 2022, the base price was approximately $63,000. If Cox Automotive is to be believed, it is possible to lease the Model Y for a monthly payment of less than $400 in certain circumstances. Furthermore, it is important to acknowledge the substantial price reductions that Tesla offers on its self-driving feature, which has decreased by 33% to $8,000. In conclusion, the Tesla Model Y remains eligible to receive a $7,500 federal tax credit. Profit margin has been logically reduced by substantial discounts. Consequently, many doubt that Tesla earns more than 10 to 15% on EVs at this time. The first quarter witnessed a decline of 55% in net income and 9% in total revenue, or approximately $21.3 billion in absolute terms. Even though declining growth and coerced discounts are the primary causes of the decline, Tesla still faces a multitude of future obstacles that could result in financial losses comparable to those experienced by traditional automakers. More specifically, President Biden recently declared the imposition of additional tariffs on batteries and other electric vehicle components sourced from China. Given that several Tesla models incorporate these components, the Austin-based company will be faced with one of two alternatives: further reduce profit margins or raise prices, the latter of which could further decelerate sales. Number 4. A low-cost mass production EV initiative has been canceled. An additional significant concern pertains to a recent report obtained from Reuters, which suggests that Tesla has abandoned the development of the Model 2. Specifically, in light of the present diminished profitability, it became indisputable that Tesla would need to curtail its investment activities. Either the affordable and compact EV or the robot taxi was available. Tesla eventually decided to abandon the Model 2 compact electric vehicle project. With a starting price ranging from $25,000 to $30,000, that model was anticipated to be a bestseller. However, recent adjustments made it apparent that Tesla could not maintain profit margins at such prices. Therefore, the robotaxi was the option. Reuters' report was never refuted by Musk or any other Tesla representative, which is an intriguing fact. Furthermore, the debut of the robot taxi, the first autonomous vehicle developed by the company, appears imminent. The newest reports indicate that we will learn additional information regarding this and other forthcoming projects of the world's foremost EV manufacturer in August. Number 3. Challenges in the Chinese market. China is without a doubt one of the most vital markets for Tesla. Since its inception, the Austin-based company has maintained a significant presence and achieved remarkable success in this region. It currently occupies the second spot on the market, trailing only BYD, but there appears to be an indication of a modest downward trend. Presently, Tesla controls an estimated 10% share of the electric vehicle EV market in China. However, the company has experienced a persistent decline in sales. As per certain sources, the initial quarter of this year concluded with a substantial decline exceeding 40%, as evidenced by sales figures that remain stagnant at approximately 300,000. The issue at hand is profound and intricate, transcending the perpetual expansion of domestic competition. BYD has recently initiated a price war, which inevitably has an impact on Tesla's profitability. However, it is also crucial to consider the Chinese government's response to Biden's announcement that it would impose astronomical tariffs on Chinese EVs and components. Tesla's performance in this region will undoubtedly be adversely affected by any form of retaliation that China undoubtedly considers imminent. Number 2. Tesla has announced the termination of 14,000 employees. Given the multitude of occurrences and the immense pressure that Tesla's global operations are under, it is unsurprising that the moment has arrived to implement cost-cutting measures. Do you know what the simplest method is to reduce expenses? Almost everything revolves around employees, and Tesla decided to reduce its workforce by 10%. Based on a global workforce of Tesla, which exceeds 140,000 individuals, it follows that 14,000 of these employees will experience job insecurity. This decision has worldwide repercussions, impacting Tesla personnel situated in various manufacturing facilities across the globe. Over 6,000 reductions are anticipated to occur in North America. Experts have already mapped the layoffs by DOR notifications. Therefore, the precise number of employees at each facility in the United States is known. Approximately 3,300 employees will be laid off in Texas, whereas nearly 2,700 Californians are nearing the conclusion of their employment with Tesla. 700 and 285 layoffs are anticipated at the Nevada and Buffalo factories, respectively. Regarding the remainder of the globe, it is anticipated that the majority of layoffs will occur in China, with some sources estimating 400 in Germany. Particularly intriguing is the fact that in addition to lower-level employees, higher management is also affected by these layoffs, culminating in the departure of 2 key company executives. Rohan Patel, VP of Public Policy and Business Development, and Drew Baglino, SVP of Powertrain and Energy at Tesla. To begin with, Tesla's stock prices are declining. Not to mention the Cybertruck issues that have arisen, sales decline, price reductions, employee cutbacks, and a modest profit, just a few of the negative developments that have transpired at Tesla recently. It is not difficult to discern the outcome when all of this is considered. Tesla shares have been declining for some time, and we honestly do not anticipate this trend to reverse anytime soon. The stock has experienced a consistent daily decline, with April being particularly difficult. The year-to-date decline stands at 43%. Presently, Tesla is ranked second worst among S&P 500 companies, and projections for the remainder of the year are not exactly encouraging. Revenue would decline by 5.1% annually, marking the first annual decline in 4 years since the COVID-19 pandemic disrupted operations in the second quarter of 2020. Put simply, the electric vehicle EV industry is poised to experience significant upheaval, and this time it will not be limited to established manufacturers. Thanks for watching. Don't forget to like, subscribe, and hit the bell icon to stay updated with our latest content. See you in the next video.